Why wait for 20 years when you can get those dividends now, right? But what actually happens when you only buy high-yielding dividend stocks? Let's find out. We will compare a group of 5 high-yielding stocks on dividend income and total performance with a group of 5 faster-growing dividend stocks from my own portfolio. For this high-yield dividend experiment, I have selected some of the highest monthly paying dividend stocks. But not the highest yielding today, no, the highest yielding on one random day in 2018. So we can actually see what happened since then. All we need is a portfolio with these stocks and their respective prices at that time. Let's do some time traveling. Average dividend yield on cost, 9%. Pretty sweet. Earlier in the year, I set a goal for myself to receive an average of 100 in dividends per month at the end of this year. With a 10k investment in 2018 in these 5 stocks, I would be almost there already, with annual dividends just shy of $925. So what the hell am I doing messing around with my current portfolio of over 18k and annual dividends at only $600? My actual portfolio has something that this high yield dividend portfolio doesn't have. Actually, 2 things. More on that later. So I'm Tom. What kind of stocks did we actually buy? Does it matter? We get the difference, right? Yield is all that matters. Not so fast. Let's see what kind of beautiful stocks we bought. The first one we bought is CLM, or Cornerstone Strategic Value Fund. So not actually a stock, but a closed-end fund. Good to note is that technically closed-end funds don't pay dividends but distributions. The 5-year price performance is almost flat, but that is the nature of closed-end funds. This fund has a management fee of 1% and an expense ratio of 1.1%, so that will eat into your profits quickly. In 2018, this fund was paying $2.84 per share in distributions. In 2021, $1.92. What else did we get? Cornerstone Total Return Fund, another closed-end fund from Cornerstone. 5-year price performance is slightly worse than the first one at -5%. Distributions per share in 2018 were $2.76 per share. 2021, $1.84 per share. Closed-end funds are a different beast altogether. Unless you understand how they work, I would suggest against investing in them. Then we have PSEC, or Prospect Capital Corporation, a business development or BDC company. 5-year price performance is actually positive at 14%. Dividends paid out in 2018, 72 cents per share. 2021, also 72 cents. Next one. Then we have ORC, or Orchid Island Capital. I already covered this one in the last episode as well. Orchid Island Capital is an M-REIT or mortgage REIT. 5-year price performance, -54%. Ouch. Dividends in 2018, $1.07 per share. In 2021, 71.5 cents per share. Next one. Then we have the absolute star of this high yield portfolio, CEN, or Center Coast Brookfield MLP and Energy Infrastructure Fund. This is another closed-end fund. 5-year price performance, -85.7%. Holy Distributions paid in 2018, $12.5 per share. In 2021, 67 cents per share. Whoa. Imagine if you are living off that income and in 3 years' time it is decimated by almost 95%. What happens if you only buy high dividend yield stocks? In this experiment your investment would have gone down by 20.7% in 3 years. But Tom, we bought these stocks for the dividend income, not the capital appreciation. Okay. Fair point. The dividend income went from $1,532 in 2018 to $1,341 in 2021. Not exactly a growing stream of dividends now, is it? So what to do instead so your dividend income actually grows? Well, for one, stay out of investment types you don't understand. All the stocks in this experiment are more complex than regular companies. And if you want your dividend income to grow, look for companies that have a history of growing their dividends in a safe and sustainable way. I made videos about several of these kinds of stocks, but here are a few that are my personal favorites and are actually part of my portfolio. First one, T. Rowe Price, an asset management company with a current yield of only 2%. The recent dividend increases though have all been in the 20% range and they paid out a special dividend not long ago. One of the best performing companies in my portfolio with a price increase of 212% over the last 5 years. Then we have Williams-Sonoma, ticker WSM. The actual best performing stock in my portfolio. Williams-Sonoma is a specialty retailer focused on products for your home, from cookingware to furnishing products to decorative accessoires. Current yield again low at 1.3%, but their most recent dividend increase was also 20%. 5-year price increase is 300+%. Then we have Broadcom, one of my recent buys. Ticker AVGO. Broadcom is one of the largest semiconductor companies and a competitor of another semiconductor company I own. Broadcom did shoot up quite a bit after I bought it and is now yielding 2.5%. Their most recent dividend increase was 11%. And I expect another double-digit increase coming very soon. 5-year price performance at 236%. But Tom, the current yield is so low. Yeah, that's why I also have companies like Enbridge, a pipeline infrastructure company. Current yield 6.6%. Their most recent dividend increase was only 3%, but I expect slightly higher increases in the future. Be aware that this is a Canadian company. Another higher yielding company in my portfolio, Omega Healthcare Investors, one I've covered quite a bit on this channel. Omega Healthcare Investors is a skilled nursing facility REIT. Current yield is at 9.3%. They have not raised their dividends in the last 2 years though. Be aware that Omega is facing some headwinds currently, with operators struggling to pay their rent due to the current pandemic and staffing issues. Why did I pick these companies? Because most of them are growing businesses and businesses I can to some level understand. The dividends and share price going up for these stocks is no accident. If businesses and profits grow, so do their dividends and the share price will eventually follow. Just look at the revenue of T. Rowe Price, or Williams-Sonoma, Broadcom, and Enbridge. All have growing revenue, meaning the business is growing. The exception is OHI, which to me is a longer term play that also involves more risk. Back to the high yielding stocks. If we compare the performance of these 5 stocks with the 5 high yield stocks from before, we can see a clear difference. The overall performance of the 5 high yield stocks is a lot lower than that of these 5 stocks. Just look at the massive difference. The first high yield portfolio has a compounded annual growth rate or CAGR of 8.3%, while the second portfolio has a CAGR of 24%. And the dividend income, the high yield portfolio is downtrending, while the second portfolio is uptrending. So the income from dividends is actually growing for the second group. So there you have it. We now know what can actually happen if you only buy high yielding dividend stocks. Want to get more ideas on how to create a diverse portfolio with both a high current yield and a growing stream of dividends? Check out the video on the right for an overview of my whole portfolio.